Thank you very much, Ben, and welcome everyone to this panel discussion on Can Regulation Save Cryptocurrencies? I very much so hope you have enjoyed the conference so far. We hope we can enrich that experience further with a fascinating panel discussion exploring the role of policymakers and regulators in creating stability in the cryptocurrency ecosystem. So we have an esteemed panel to present to you. They will introduce themselves more fully, but please let me introduce Commissioner Kristin Johnson of the US Commodities Futures Trading Commission, Doris Dietze, Head of Digital Finance, Payment Services and Cybersecurity, the Federal Ministry of Finance in Germany, Kilvar Kessler, the Chairman of the Board of the Estonian Financial Supervision and Resolution Authority, and last but by no means least, Giuseppe Siani, Director General for Financial Supervision and Regulation at the Bank of Italy. And yes, my name is Jodi Norman, and I am a partner with global law firm Allen & Overy, and I head the Middle East Financial Services Regulatory Practice. It's my pleasure to be moderating this panel and be in the company of such esteemed guests. So let's kick off this session with what I think is a provocative question. Earlier in the week, when I was promoting this panel on social media, I asked the question, can regulation save cryptocurrency? And I got a very quick response in terms of, should we be regulating cryptocurrencies at all? And it's a good question to start with. So maybe I could hand that over to you, Commissioner Johnson, to give us an overview as to whether or not we should be regulating crypto.
Jodi, thank you so very much for moderating us today. I look forward to hearing from each of the panelists who are, as you described, very much esteemed and also deeply engaged immediately in applying our existing regulatory authority to the markets that emerge, as well as those that have been longstanding. I would just say really quickly, if I could, that your comment about a social media prompt reminds me of a television series here in the United States titled Game of Thrones. It's based on a novel by George R.R. Martin, A Song of Fire and Ice. And the first book in the series is Game of Thrones. In that series, there is a family whose crest is marked with the following words: winter is coming. In part, as a regulator, I feel that a portion of my job is to help secure the stability of markets against what we know to be a reality of procyclicality, and that is that winter is coming, or that markets will transition among stages. And in the context of those transitions, there can be frictions, significant losses, including solvency and liquidity crises for any firm. So when we think about traditional finance, which we could describe as TradeFi, what we appreciate when we consider the potential for winter is that we have built in significant resolution and resiliency mechanisms. We've also developed recovery mechanisms to ensure against the losses of market participants or to mitigate those losses, as well as to mitigate the losses that investors or customers may experience. What I might also point out quickly is that in the context of thinking about the recent financial crisis and what we might describe as the current crypto winter, there are at least 4 attributes that I would suggest are similar: liquidity constraints, funding mismatches, leverage, and interconnectedness. If I were to highlight a specific few examples that I think we are all familiar with at this point in the crypto winter, firms that have had significant difficulty navigating volatility in price, I might point to Three Arrows or Celsius as examples of why it is important to ensure the infrastructure, the regulatory infrastructure, internal within an individual firm to mitigate enterprise risk, and externally by supervisory authorities to ensure against the potential that a crisis at one firm could lead to crises across an industry. And so thinking about that again, last week, the U.S. FSOC released a report that outlined concerns regarding the operational frictions that are very prevalent in crypto markets and the potential that adding or express oversight with respect to certain of these frictions might mitigate the losses that firms experience and minimize the extent that customers find themselves on such a roller coaster ride. So I would just highlight that I think there are significant benefits, and we see them in the context of crypto winters. We can imagine applying existing regulatory approaches in these markets might in fact enhance and stabilize the markets and benefit all market participants.
Thank you, Commissioner Johnson. It's really interesting for you to draw on the parallels that we've seen in previous financial crisis in the context of the more recent crypto winter. Giuseppe, I wonder if you wouldn't mind talking a little bit more about those parallels and maybe how we go about identifying risks that we can manage through regulation.
Thank you very much, Jodi, and thank you for inviting me to this very important event and a very informative discussion. I think that before trying to answer indeed the question that you posed at the beginning, we should be very careful also to avoid maybe reinventing the wheel and understanding what the current situation and current regulation might apply to. So indeed, if we look at the global financial crisis, where we had, the main bad events were driven by excessive leverage, great interconnectedness, and liquidity mismatch, like the commissioner said before, then we do not see a lot of differences. Because indeed, these are really the drivers of the main crisis that we experienced in the past. So the issue is not whether we have something truly different, is to whether we have the risks that are adequately mapped before considering a new regulation. And indeed, if we look at the risks with the crypto asset, we have three components, right, that we should look at. We have instruments, we have intermediaries, and we have technology. So my opinion is that we do not have a brand new risk that we should look at, but we should look at maybe some different nuances of already existing risks that have been already mapped and regulated. So, for example, I believe that in the crypto asset markets, the operational risk is one of the main drivers for concerns, together with the legal and reputational risk. The technology, it goes without saying, plays an important role, but it's also fair to say that at the global level and a European level, we already have plenty of standards and regulation that have helped mitigate this risk. So what is missing then, before, of course, leaving the floor to other panelists? I think that what is missing is a fully capture of this vertical integration of the three components. Again, instruments, intermediaries, and technology. For example, if we look at the technology, we have the governance of the technology underpinning the crypto asset that might raise some issues because there is, you might argue there is no governance there, or at least in the traditional application of the DLT. And this might pose an issue in terms of lack of data entry to regulation and supervision. And second, also maybe a massive consumption of energy. The second issue is indeed the perimeter that of the regulation supervision that might be undermined. So there is no data entry to discuss issues that we see. And the third could be also the lack of proper data in order to better understand where the risks are. But with respect to the traditional risks, you might argue that we have really similar risks that we have seen so far in terms of financial risk. If any intermediary is responsible for managing the underlying reserves that underpins crypto asset, then we have plenty of standards and regulation. If we look also at credit risk, even though it's a much less material risk driver than others. And in terms of, again, this leads me to the issue of the role that intermediaries might play. So maybe we should investigate further the role of intermediaries as custodian. For example, custodian of the crypto keys, or maybe custodian of softwares developed by third party or fourth party. So you see, there are some potential drivers for additional discussion today, but I would stop here, also leaving the floor to the other panelists.
Thanks, Giuseppe. That's really interesting in terms of, the path to regulation and making sure that we're not reinventing the wheel and that we make sure in advance that risks are adequately mapped. I wonder, Doris, if this is a good point for you to step in and talk about maybe the development of the European legislation, the MiCA, and how that seeks to address some of the risks that Giuseppe's highlighted.
Yes, thank you very much, Jodi, and thank you very much also for the invitation and the possibility to participate in this distinguished panel. Maybe before coming to Mika, actually, coming back to your question, should we regulate crypto at all? Which is quite difficult for me to answer, since in Germany we were in the position that actually crypto assets and crypto asset service providers were regulated from the very beginning on. Why come that? And that's is because we already had in our national financial market legislation a provision which covers units of account. And basically what we did, we qualified crypto assets as unit of accounts, and therefore we had already the existing financial principles in place to cover all the risks along, including AML risks and so on. So that is why I can say, at least in Germany, crypto asset service providers were never unregulated. So what we see now on European level is that the European Commission published a proposal for MiCA. You already mentioned it. A regulation for crypto assets, and which aim is to develop a harmonized market for crypto asset issuers, but also crypto asset service providers. By doing so, basically what the legislation does, it takes existing financial market principles and applies them to crypto assets. So the Act itself relies on principles we already see in payments legislation, but also in what we see in existing securities legislation and money market funds regulation. And it basically takes the best of all of it and applies it to certain crypto assets. MiCA itself covers so-called stable coins, which means asset reference token and e-money tokens, as well as so-called utility tokens. In detail, what does MiCA do? For all service providers of crypto assets, as well as the issuers of so-called stable coins, they implement a supervisory regime which can be supervised by national supervisors, but also by the European supervisors too. And it also adds some transparency regulation for consumer and investor protection issues. So what we basically see is a bit what Giuseppe said. We are taking existing financial market regulation, which we are familiar of, to address similar risks, which Giuseppe also mentioned, and apply them to MiCA. After all, I also admit MiCA only applies to service providers and issuers of crypto assets which are not already covered by other European financial market legislation. And this is, in a case-to-case basis, probably not quite easy to distinguish, because, as we see, there are quite a lot of similarities. Yes, maybe I would leave it to that at this point.
Thank you, Doris. And then maybe can we touch on the point of technology? So Giuseppe, you said one of your 3 buckets was around technology and how that's important to this particular asset class. So Kilvar, I wonder if you can talk about technology and how it plays an important role in this market, and as a regulator, why it's important to understand the technological side of things.
Thanks, wonderful, excellent question. I always enjoy talking about technology. Anyway, good to be in this distinguished panel. And just to warm up, I mean, I'm coming from Estonia, and you know, beginning of this century, within the framework of our digital society, we already created the digital signature solutions, which were what came to cryptography part of it, running on the basis which is similar or now known as a blockchain technology. So this is nothing that new for us. And actually, if you ask from me whether this has been value added for society, namely the digital signature, I would say that transaction costs have been cut pretty extensively. I mean, take the example of COVID, where, for example, I mean, it was very easy to sign not papers, but files remotely, and business never stopped in Estonia. Well, now to the topic. Yes, indeed. I mean, my hobby is all is taking pictures of nature photography, and I have noticed that if you have more more variety there, the risks are better managed in a way. The risks are not that concentrated. So basically, the more the merrier. More systems we have, more competitors in the financial markets we have. It's great. It's value added. Once again, having said that, and also in a way repeating what Mr. Giuseppe Siani already told us, is that indeed with cryptocurrencies and other similar stuff, there is a quite heavy technological side present. And from the regulatory point of view, from the supervisory point of view, you need to create capacity there to understand it. So basically, in my authority, in addition to lawyer or legal know-how, in addition to the financial know-how, we are creating, and we have created also technological know-how. I mean, it's our point that you as a supervisor, for you can't have black boxes, so to say, that somebody shows that, well, this is working properly and you don't understand what it is. So once again, operational risks and namely technological risks are rising. They are very important for supervisor to build the capacity as well. And basically we are supporting the technological developments and we are not killing them per se. So let's see how they work out, so to say, and if not, let's say them goodbye. But if they work out, they are welcome in our market. So it's very briefly on our attitude and how the market works in Estonia.
Fantastic. And I mean, I'll open this one to the floor in terms of, whether or not there is actually a need or a space for regulatory sandboxes or other kind of environments where new technologies and new asset classes can be tested before actually being more widely available in the markets. Any volunteers?
Now, if I may start off, I mean, basically we haven't used the term sandbox in our history. I mean, I remember a couple of years ago it was a very popular term, but we have been labeling ourselves that the whole financial market here is one big sandbox. For us, it boils down very good and open dialogue between the market participants and also supervisor. I mean, is it a sandbox or not? I don't know, but it's a mutual trust and it's a good open dialogue. Without that, I can't even imagine how supervisor would work.
So if I can hop in, Jodi, and just share, this is such a rich dialogue, in part because it gives us a chance to think about collaboratively how to begin to approach novel technologies. And I just want to layer in a couple of things because so far so many great reflections have been shared. The first is I concur with the economic analysis of introducing new technologies. We are achieving greater efficiencies, reducing transaction costs, and increasing access to many types of consumers that might have historically been excluded from participation in traditional financial markets. I believe that these are net positive gains that we can see as the market matures and as technologies mature that have been adopted in this ecosystem. Very specifically here, I think I was appreciative of Giuseppe's references to the adoption of open source protocols that really have enhanced the ability of developers to craft software that would facilitate many of these gains. At the same time, Giuseppe mentioned, and I want to concur with the reality that governance is a critical question at the core of how we will address these new technologies. And it also offers a wonderful bridge to discussing something that I believe Doris mentioned. We in the United States are taking the position, as Kilvar also noted, that these innovative financial products are occurring in markets that were already operating. We see that in the context of AI, for example, before we began to explore and question how to develop regulation to address the use of AI in crypto markets, we had already long begun to have this conversation with traditional financial market participants who were adopting sophisticated modeling tactics for purposes of predicting pricing, mitigating frictions, identifying trends. So the notion of the integration of many of the pre-existing technologies, such as AI, although they are increasingly more advanced, had already been happening in traditional markets. So to a certain extent, we have a new, I think, instrument, Giuseppe called the financial products we might point to here. They may or may not involve intermediaries. The governance then of how to deal with the lack of intermediaries to whom we could look for requirements regarding extra layers of capital, those kinds of cushions that mitigate the kinds of concerns that arise when market conditions are not optimal. And in fact, when market conditions can turn fairly quickly and be very challenging. So what I just layer onto that conversation is that we too have taken the perspective that our existing law in fact does apply. And the Securities Exchange Commission, our sister agency, and the CFTC, the Commodity Futures Trading Commission, agree that there is within our remit authority to immediately enforce against certain types of activities, notwithstanding the technology. So technology agnostic, financial product agnostic, if conduct violates the law, we are prepared in every instance to enforce the law as Congress has given us authority. So to that end, we have brought first of their kind enforcement actions that essentially establish that if you pump and dump or engage in a practice where you artificially inflate the price of a security or commodity, you will likely find that the SEC and CFTC, in almost parallel, near partnership and cooperation, collaboration, are ensuring that those enforcement actions are brought. Earlier this year, the CFTC brought such an action against a pump and dump scheme. We're also enforcing against anyone who might violate Bank Secrecy Act obligations. So these are consistent with what you would know globally as Know Your Customer, CIP, anti-money laundering requirements to verify the identity and sources of funds flowing through our financial system. We could also point to a recent insider trading case and even a more recent and novel case involving application of enforcement regulations against a DAO brought by the CFTC. It is the case that we've seen a parallel action brought by the SEC with a very rigorous report illustrating that with respect to violations or misconduct of existing regulations, we, again, are technology or product agnostic. We believe the behavior and the conduct is always inappropriate and impermissible and illegal, and will therefore follow up accordingly. I just add one last thing, and this is to tie to Doris's wonderful description of MiCA and what it is advancing. There are two significant bipartisan bills currently in U.S. Congress that would extend the remit of the CFTC over the spot market for certain cryptocurrencies, coins or tokens. And this authority would enable us to expressly begin to regulate certain types of activities that may, in the current moment, exist in a regulatory gap. So our remit in terms of enforcement is very broad against anti-fraud and market manipulation. Our ability to require registration of the entities that custody funds, of the entities that facilitate trading, of the entities that are directly engaged in offering opportunities for customers and investors to participate in these markets is not yet fully clear. So we are hopeful in anticipating legislation from Congress that resolves these gaps. The White House has expressly solicited and requested the report I referenced earlier, as well as assistance from Congress and regulators to write the law that would govern this space. So I'll just pause there.
Thank you, Commissioner Johnson. Giuseppe, please.
Oh, sorry. No, sorry. I just wanted to make two quick comments as a follow-up to also what Kilvar and the Commissioner said. On the also your question, do we need a sandbox? Look, we have a sandbox in Italy, and this has helped us a lot to interact with the industry and better understand the developments. On the other hand, I think that the best sandbox is really our daily work on the ground, because like Kilvar said, we indeed, as a prudential supervisor, we cannot wait for the new regulation. We need to work on a daily basis in order to intercept some issues that maybe are not fully covered. And we have a very good cooperation with the other SSM supervisors, including the German ones. Because then by the time that we start to apply the AML regulation, the prudential regulation in terms of governance, then it's easier to detect issues that we do not like. And innovation, like Commissioner said, is indeed key to improve the financial system. I think that we should always remember that we are not here to kill innovation. On the other hand, we need to ensure that these technological innovation happens within an informed framework where the intermediaries and all the stakeholders act in an informed way, starting from the top of the governance in terms of board of directors and going down to the business lines and risk manager. Because what we should avoid is that any intermediary and also can use instruments or can enter new business without having a full understanding of the relevant risk. That's absolutely key. And then that's why I mentioned before the fact that we should never lose the perspective of the vertical integration of these three drivers, Jodi, that I mentioned. If we look at from the global perspective, you have the IOSCO that looks at the instruments, right? Then we have the CPMI that looks at the payment infrastructure. Then we have the Basel Committee that looks at prudential perspective. And then what we need to ensure is that nothing is missed. And then we need to look at something that might help reduce the risk. And again, in terms of governance of the underlying technology, the big question is, so far we have not interfered with the development of the governance arrangements in the system. Then the question is, should we start looking at possible constraints to the governance of the market? So far, both at the global and the European level, this has not been the case. But given that also what happens in some DLT and blockchain, that maybe you have always this reliance on the proof of work, which takes a lot of time and energy to reconcile the ledgers. The question is, should we maybe introduce some constraints in order to promote a more efficient, effective governance in the DLT? But this is a very sensitive question, and then I would stop here.
Fantastic. So I guess what I'm hearing here is there are a lot of risks, if I may, there are a lot of risks that we're familiar with from more traditional, conventional financial markets, and we can take those learnings and apply them to the world of crypto. But I think I'm also hearing there's a lot of differentiation. There are new challenges that we have to face in the context of regulating this asset class. And a few, if I may, a problem of regulation in a decentralized space, going to your point, Giuseppe, about governance, the classification of cryptocurrencies and maybe a divergence in approach across jurisdictions, and also a question of having appropriate data. I wonder if we could tackle those questions. So if I may go back to the question of how do we regulate in a decentralized space? What are some of the challenges and what are some of the possible solutions? Doris, maybe I'll hand that over to you. So Doris, I've lost your audio. I'm not sure if anyone else is in the same situation.
Okay, it's better now?
There we are.
Oh,
Perfect.
Yeah.
I think you already mentioned the biggest challenge by mentioning DeFi. So, well, from a general perspective, I probably would say that 80% of what we see in crypto is already covered by existing principles of financial market regulation or principles which are comparable and applicable to crypto. However, I also would see three challenges which are not fully covered, or where existing financial market regulation probably could not be applied one-to-one. And the first is, in my opinion, the global reach at once. What do I mean by saying that? It's the speed of global transmission as soon as someone issues a crypto token, and there's actually the possibility to have a global reach within seconds. So, and that underlines the importance of international cooperation in the field of crypto and the work international standard setting bodies are doing there. Second, it's what you already mentioned is DeFi. How do we deal with networks or issuance of tokens in a peer-to-peer network where no intermediaries are involved? Because in this case, you really have to ask who could be the addressee of a potential regulation, and furthermore, who is responsible for what in the whole service which is provided, and who's able to handle which risks. And this is a question which is not easy to answer, since regulation normally always needs someone to address, and normally that's a natural or legal person. And how do you deal with a situation where such a person is missing, or which could then be the person who is in charge. That's the second issue where I think we still need some further thoughts on. And the third one is kind of, I would call it new asset class. And for example, I would like to manage non-fungible tokens here. Because when we look at NFTs, there's not always something comparable in a physical world to it. You can really argue and discuss for quite a while whether NFTs are financial instruments and should be treated like financial instruments, or whether they are commodities and should be treated like things and comparable things. So that is why in MiCA they try to find a kind of solution in the middle, or way in the middle to go, by basically saying NFTs in general are not covered. However, as soon as NFTs are something comparable like financial instruments or tradable similar, they should fall under the supervisory regime. So yes, these I think are the three main aspects which could not be one-to-one covered by existing regulation, and where we still need some further work to do, and where I'm very grateful that the international standard setting bodies are exactly looking at those things.
Thank you, Doris. And then any of our other panelists want to talk to the challenges of developing effective regulation?
I'm happy to say a few words here.
Well, yeah, I was actually going to go to you next, Commissioner Johnson, to talk about, obviously everything Doris said there talks about the globalization of this market, maybe more so than others, given its decentralized nature, given the technology enablement. How do we go about achieving regulatory convergence in such a space? I know you've been focused on that.
This is a helpful question, Jodi. It really is a great bridge from Doris's comments, in large part because Doris highlights something that is a few points that that immediately resonate with us. We are in the midst of an environment where attempting to identify the legal person who should be responsible for purposes of, as I mentioned earlier, engaging directly with a market regulator. In our markets, those market regulators are the Securities Exchange Commission and the Commodity Futures Trading Commission. And the Commodity Futures Trading Commission, for certain types of contracts released by software protocol or coins or tokens involved in certain types of contracts as the underlying asset that is described in the contracts, when those types of contracts, often margined, leveraged, collateralized investment products, are released and made available to investors, we have expectations about which market participants are permitted to engage in the use of those contracts, and what the intermediaries that might facilitate. And I thought Doris made a great point earlier: secondary market trading of these instruments. So I think there are 2 or 3 pieces to the puzzle here that I would really underscore immediately that are part of our regulatory framework, but we have mapped on over many years of cooperation and collaboration to the regulatory framework that our counterparts in jurisdictions around the world have adopted. So specifically here, the 2 or 3 attributes that I think become really critical are: there is a decentralized nature to DLT, distributed digital ledger technology, that really does facilitate, as Doris pointed out, an exceptional speed of distribution and execution of transactions. There are also trading platforms that are facilitating the trading of these transactions that operate, in some instances, arguing that they are not attached to any jurisdiction, posing a very new question for regulatory cooperation, or requiring a much greater emphasis, one might say, on the necessity of regulatory cooperation to establish, as Doris pointed out, those international standards that impose a floor beneath which jurisdictions will agree they would not permit trading or transactions or activity to fall below. And so what I'd highlight about that secondary market trading is, yes, the origination and distribution of coins and tokens globally can happen near instantaneously. Secondary market trading can take place on platforms that are not organized in any jurisdiction, as they might argue, but I would argue, subject to the laws of many jurisdictions, the jurisdictions where investors or customers are executing transactions on those platforms. And I would highlight that one of the critical pieces to this puzzle for me as a commissioner, one of my highest priorities, is protecting the investors who cannot fully appreciate the depth of detail, the intricacy, the sophistication of these technologies, and who may suffer losses that they will be unable to recover from as a result of their participation. So last week, the Financial Times announced on Friday morning that a very large internationally operating secondary market trading platform facilitating the execution and trading of cryptocurrency and coin transactions experienced a significant hack, and that resulted in a $100 million loss of customer funds. I think the number has fluctuated as reports have varied, but we don't need to look at that one incident to make the point. There are so many, and the volume of funds customers are losing to cybersecurity threats and attacks now reaches the billions of dollars, the $1 billion mark plus globally. All pointing to a necessity that we find a mechanism to cooperate as we have in the past and collaborate to establish, in accordance with the core principles Doris mentioned, very clear regulatory guidelines that will make plain what our expectations as regulators are for the protection of investors within our markets, and presumptively at some point, as the FSOC report points out, ensuring against any knock-on effects across other products where there may be interconnectedness or other financial market spaces that could be impacted by significant downturn or disruption in the market for the crypto ecosystem.
Thank you for that. And I think it takes us nicely onto a point around how do we keep the crypto markets clean? This asset class is anonymity. It's often associated with criminal activity, AML concerns, more recently with market abuse scandals, and sometimes with Ponzi-like schemes and multi-layer marketing type schemes that we have seen in the past. So, my question to the panel is around how do we keep the crypto markets clean? There's an ongoing question to the extent that existing insider trading and market manipulation laws may or may not be fit for purpose. I know, for example, in Europe, MiCA seeks to address the gap in the market abuse regulation to capture this asset class, whereas Commissioner Johnson, we've spoken in the past around the CFTC feeling like they have the right enforcement mechanisms in place already to pursue enforcement action. Would anyone like to talk to that point?
Yeah, it's a difficult topic. If I may start, it's a quite difficult topic. Nobody wants to talk about the darkest side of the market. But if I may kick off, so to say, basically there are two angles to this. First is kind of working regulation and the toolbox for competent authorities. And then the cooperation side, we already discussed about cooperation. And basically for me, maybe it's too simplistic view, but it's my experience. If society in a way sees or feels that the risks are realizing with regard to, for example, crypto markets, the demand for a how to say more swift enforcement will be there, and this will be a catalyst for the international cooperation as well. So basically, we as civil servants, what a wonderful name! I mean, it has a merit in it. So basically, if society orders us to do something, we will find a way. And now to put it into more factual kind of framework, unfortunately in Estonia a couple of years ago, there was a situation where we had almost 2,000 registered WASPs. So, and this supervision was carried out by our FIU, which was part of police force. And we saw that, we as a financial supervisor, we saw that the risks are there. So basically we reorganized all this structure, institutional structure. Now this FIU is independent agency, which is managed by our former colleague, and the number of WASPs, registered WASPs, has fallen from 2,000 to 170. And this pure enforcement work, really. and it's tough enforcement work. So this is one angle, how to keep markets clean, as you say. Having said that, I mean, regulation, and coming from a smaller country, and in a way from time to time we are suffering because of that. Sometimes it's very easy to regulate, but for a smaller market participants who are purely, how to say, they are not the bad apples, it's very difficult for them to bear the regulatory costs, so to say. And then you have not that much competition, and maybe also innovation is lacking. So it's very difficult puzzle, so to say, how to attack. And I gave you one example how we did it in Estonia.
Thank you, Kilvar. Maybe the US angle, Commissioner Johnson?
Thanks so much, Jodi. I'll be very quick. I just want to point out a couple of things in terms of keeping markets clean. I referenced earlier, we are enforcing immediately, taking a page from Giuseppe's earlier comments. There are no barriers that would prohibit or should prohibit effective oversight, policing against anti-money laundering and other illicit and illegal use or transfers of monies through our financial system. So that's one critical piece, but I want to highlight two others, that one you referenced, and then a second. The first is with respect to enforcement. Specifically, you raised insider trading. So in the United States, unique, I think in many ways, we have a very robust jurisprudence that essentially developed out of a Supreme Court interpretation of exactly what the breadth of anti-fraud protections would be. And the interpretation empowered the Securities Exchange Commission and then ultimately the Commodities Future Trading Commission to, in the context of securities and commodities markets, pursue doggedly any attempts to manipulate markets while in possession of material non-public information. We then refined our understanding of what that meant. It includes classical insiders, the CEO, the president of a company, board of directors who are in possession of information about the possibility that a company might launch an IPO. We extended that to constructive insiders, the accountants, the lawyers who work with these firms. And over time, we've extended it further with some friction and uncertainty to apply to certain types of folks engaged in service provision who may stumble across information in the execution of their duties, prohibiting them from benefiting from possession of information that is material information ahead of the use of the revelation to markets of the same information. I want to highlight here that in the context of cryptocurrency markets, we believe this legal theory would absolutely apply. Recently, the Securities Exchange Commission brought a case alleging that certain employees of an intermediary, a secondary market trading platform, gained access to material non-public information about listings, and then brought an action against those individuals who proceeded to trade intentionally while in possession of that material non-public information. Well, Jodi, those were humans, and I think that case was somewhat novel, but I agree with the application of the principles there. The questions are, however, many as we begin to explore what this means for decentralized, distributed markets, networked markets. So in particular, I'm thoughtful about, as we are part of this broader conversation, the integration of AI in markets. And I referenced earlier AI for purposes of predicting pricing, modeling out risk scenarios. In addition to that, we could imagine the use of it for a variety of high-frequency trading tactics. All of that is now being imported into the crypto ecosystem. And what would or could that mean? Well, we've already described the notion that governance in a decentralized networked firm could mean that we don't have the conventional board of directors, we don't have the conventional president, we can't impose the risk management committee upon the entity, at least immediately, as our regulations may exist. They may need some adjustment to your question of whether or not they're fit for purpose. In the United States, we only recently began to federally require state-organized corporations to adopt very specific governance structures to ensure against fraud and disruption of markets. In particular, in the Dodd-Frank Act, we imposed upon banking entities an obligation that they have risk management committees. That obligation is flowing through even through market regulators' expectations as we at the CFTC are considering governance obligations for intermediaries in our markets, imposing, again, risk management committees or expectations that data regarding risk management is captured. As the entities are decentralized and artificial intelligence really may make it harder to pinpoint activity that we would obviously find concerning, because isn't it the purpose of a supervised or unsupervised machine learning algorithm to identify trends and patterns and to potentially surface information that is not yet clearly visible to the human eye, one could argue. So our philosophical approach to enforcing insider trading is something that is likely to require some careful refining as we transition into a space that is more technologically central and maybe less human-centric. And then I'd finally just add, I know we won't have time to cover, but one of the other things I'm thoughtful about is how we as a regulatory agency can integrate artificial intelligence in our oversight of markets. Specifically here, I'm thoughtful about the integration of AI and very specific data initiatives to surveil markets, to protect against market manipulation and to identify instances of fraud, trading patterns and conduct in DeFi or traditional financial markets that establish activity that is likely connected to someone having used information inappropriately or someone having engaged in conduct that we would otherwise enforce against. So just a couple of quick points to layer on, probably not enough time to cover them all.
There's never enough time. And Giuseppe, I did see a hand go up just before Commissioner Johnson started speaking. Anything to add?
No. Yeah, thank you. Maybe 30 seconds just for two quick remarks. The first one, we have spoken a lot about cooperation in the public sector. I think that what is key, also by drawing from the past, is a cooperation also with the private sector. The private sector must play a role to clean the market, like it has happened in the past. That we should work together also to try to develop strong quality standards, or maybe identify sound practices in order to clean jointly the market while respecting each other's role, like it happened in the past. And the second, indeed, MiCA represents a significant step in the right direction, massive improvement of situation. But maybe we needed to improve that further because MiCA will still be applied on a legal entity basis. And maybe in order to avoid and need to be consistent with what the commissioner said before, we should move towards more a function-based type of regulation in order to avoid that, depending on the legal head, we might take the risk of missing some important piece of the puzzle. I will stop here. Thank you very much.
Thank you, Giuseppe. Anything, Kilvar, Doris, to add to that conversation and debate?
Since I'm not a supervisioner, so to say, but from the policy side, the only thing I could add here is that, of course, legislation is setting the framework, but it's all about enforcement when it's gotten, which is very important to build trust in the market, and therefore enforcement has to work. And with regard to the crypto sphere, we see the importance of international cooperation here, as mentioned by the commissioner and Giuseppe Siani already, and we should not forget the international standard setter here as well, which are doing great work. For example, the FATF setting important standards also for the crypto area with regard to AML and CTF.
It's incredibly difficult because the answer is so simple, one of international cooperation and effective enforcement, but unfortunately it's much more harder in the execution, and with these new asset classes, with decentralized players, without being able to identify those legal and natural persons, it's certainly going to be a challenge to make sure that we get this right. I'm conscious of where we are at time. We have 8 minutes left. So I actually think it would be lovely if I could just give 2 minutes to each of you to finish with concluding remarks, anything we haven't touched on. I know in our previous conversations, we've talked about things like the sustainability of the crypto world, et cetera, et cetera. So any last thoughts? I'll start with you, Giuseppe.
No, as I said before, we should not reinvent the wheel, and we should never forget the past memory. I think that the crypto asset represents a significant change in our long-standing paradigm, but maybe we can learn from the past, and we should indeed ensure that there is an informed governance of the relevant risk, full awareness at the highest level of the board, and then also try to work together, because I think that it's also in the interest of the market to develop safe and sound practices that can be implemented. But the regulation is only one part. Even strong regulation without proper implementation and strong supervision might not be fully fit for purpose. So I think that we should be consistent over the full regulatory cycle, regulation, implementation, and then proper supervision, together also with in cooperation with the market. That's how I see that we could improve the current landscape.
Thank you very much, Giuseppe. The powers that be tell me I've actually got 3 minutes, not 8. So just a minute elevator pitch from you, Kilvar.
Well, I mean, 3 things. First, from the supervisory perspective, no denial of innovation, meaning that let's keep our antennas open, so to say. Second, understanding risk, and third, addressing the risk adequately, not regulating to death, but regulating, properly. So those 3 points, what I would like to make.
Fantastic. Doris?
Yes, I would conclude just that we already achieved a lot with regard to gaining more trust into a crypto market on national, European, and also international level. However, there are still some things to do with regard to the stability of the markets and their sustainability too. So we're not running out of work.
There's always more work when it comes to financial regulation, even in a period of deregulation. Commissioner Johnson, final word.
Thanks so much, Jodi. This has been so rich and wonderful. I would just layer in a few reflections. The first is, I think cooperation has been an overarching theme that we've talked about. For us, it's internal because we are a fragmented regulatory oversight with respect to financial markets, but also reaching out and across jurisdictions to act in collaboration to effectuate rules that are consistent with the core principles Doris mentioned earlier that we all have already embedded in our regulation. And I really appreciate Giuseppe's comment just now. We didn't have time to talk about private partnerships in the standard setting space, but yes, there is a role for the international regulatory authorities. IOSCO's regulatory endeavors to begin to offer guidance here is critical. ISTA is another in our specific markets that is developing documentation for cryptocurrency futures transactions, a very important piece of the puzzle as well. And I'd layer in an SRO. We would call them SROs, self-regulatory organizations. Those are cooperative platforms where market participants come together and help to establish standards by acknowledging, because they are most intimately familiar with and closer to the innovation and technology they're developing. They offer guidance regarding the standards that would apply and be effective in an effort to achieve those core principles referenced earlier. So SRO, or self-regulatory organizations, among market participants are also going to be a critical piece to the puzzle. And finally, I would just say, honoring Kilvar's point, responsible innovation.
Fantastic. And final words from me are just thank you for such brilliant conversation. Thank you very much. I think we're done.